How does short-term versus long-term leasing affect non-resident rental taxes? Whether you're a non-resident renting your Canadian property out on Airbnb or leasing it for a full year, your rental income is taxable in Canada. But here's what many landlords miss. The way you rent, short-term or long-term, can affect how you're taxed, what you can deduct, and whether your income qualifies as passive or business income. Understanding the distinction is crucial if you want to avoid unexpected tax bills and take full advantage of CRA-approved deductions. The default rule: all rental income is taxable. No matter how you rent, the Canada Revenue Agency, CRA, considers rental income from Canadian property as Canadian source income. If you're a non-resident, you're required to either have 25% of your gross rent withheld and sent to the CRA, or file under Section 216 to be taxed on net rental income after expenses. This applies to both short-term and long-term rentals, but the tax implications shift slightly depending on how you rent. Long-term rentals, simpler, safer tax treatment. A long-term rental, usually defined as leases of 6 months or more, is treated by the CRA as passive rental income. This means you can elect under Section 216. You pay tax based on net income. You can deduct expenses like maintenance, property taxes, insurance, and mortgage interest. Your rental is considered investment income, not business income. This is the most common setup for foreign landlords and often the easiest to manage. Short-term rentals may trigger business classification. Renting your property on platforms like Airbnb or VRBO may push your income into business territory if you offer additional services, cleaning, concierge, breakfast, etc. The rental is frequent and highly active. You manage guest turnover like a hotel operation. When this happens, the CRA may reclassify your income as business income, which removes the Section 216 option, requires you to file a T1 or T2 tax return, may trigger GST, HST obligations, subjects your rental income to different tax rules and audit risk. The CRA looks at the level of activity and services to determine classification. Passive short-term rentals without services may still qualify under Section 216, but it's a gray area, especially with automated platforms. What should you do? If you're unsure whether your rental qualifies as passive or business income, speak to a tax advisor. It's always safer to classify correctly and file proactively. Also, don't assume that short-term rentals are under the radar. The CRA can access data from Airbnb and similar platforms. If you're earning rental income and not reporting it properly, penalties can stack up quickly. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.